I've been in financial services for over 25 years, and in that time, one thing I have learned is that accumulating wealth and preserving wealth often requires different planning decisions. That might sound counterintuitive, but I see it regularly. Someone sells a business, comes into a significant inheritance, or hits a major income year, and without the right planning in place, a significant portion of that wealth may be lost to taxes that could potentially have been reduced through proactive planning. I'm Matt Tuft. I'm a certified financial planner and a sports and entertainment accredited wealth management advisor with 40 North Wealth. I work with clients across the country, and my focus is on people going through significant financial transitions. They're selling a business, a major inheritance, retirement, divorce, moments where the decisions you make in a short window of time can have a long-term effect. Today, I want to walk you through the biggest mistakes I see high net worth investors make. Not to alarm you, but because in my experience, awareness is often the first step toward making more informed financial and tax decisions. One thing I believe deeply, no two people's financial situations are the same, which means no two people should be doing exactly the same things. What I'm sharing today are patterns, not prescriptions. Your situation may be different, and that's actually the point. So let's start with mistake number one, treating tax planning like a once a year event. Here's something I tell clients early in our relationship. April 15th is not a tax planning date. It's a reporting date. By the time you're sitting down to file, the decisions that determine your tax bill were already made or not made months earlier. The clients who tend to come out ahead aren't necessarily the ones with the most sophisticated strategies. They're the ones who are thinking about taxes year round, making small, intentional decisions that compound over time. That's really what comprehensive planning is. Everything I'm going to share in this video is a symptom of reactive planning. The antidote is building a team and a rhythm that keeps you ahead of the calendar, not chasing it. Mistake number two, no tax diversification across account types. Most people understand investment diversification. Don't put all your eggs in one basket. But there's another kind of diversification that gets less attention, and that can be just as consequential. How your money is taxed when you eventually access it. We call that often as the asset location strategy. I work with a lot of people who spent their careers maxing their 401k and building up traditional IRA balances. That's not a mistake. It's smart accumulation. But at some point, that tax-deferred bill comes due. And when required minimum distributions kick in at 73, they don't ask whether it's a good time for you to have a taxable income or not. So a situation I've seen more than once. I had a client, incredibly disciplined saver, successful career, who came to me after she'd already retired. When we mapped out her RMDs over the next decade, she was looking at a more taxable income in retirement than she'd earned in most of her working years. It pushed her into a higher Medicare premium bracket that she hadn't budgeted for, and there were limited options to fix it at that stage. Now, had we connected 10 years earlier, the picture would have looked very different. The goal is to build what I sometimes call a three-bucket approach. First bucket is the tax-deferred accounts, traditional IRAs, 401ks. You get the deduction now, but pay taxes on withdrawals. Second bucket would be tax-free accounts like Roth IRAs or Roth 401ks. No deduction now, but qualified withdrawals are completely tax-free. And the third is taxable brokerage accounts, flexible access, subject to capital gains rules, but no forced distribution. And a small extra bucket you could add is called the health savings account. It's worth knowing about those. They're often described as having triple tax advantages when used for qualified healthcare expenses. Having money spread across all these three give you options. You get to be strategic about which bucket you pull from and when, and that flexibility is worth a lot over a 20 or 30 year retirement. So if you do nothing without this balance, you may have less flexibility in managing taxable income during retirement. That's a significant loss of control for people who've spent decades making smart financial decisions. Let's go over mistake number three, mismanaging capital gains, especially around major events. This one is particularly relevant for those people I work with most, business owners, executives with equity compensation, People who have inherited appreciated assets, capital gains are often the single largest tax event in someone's financial life. And the difference between a well-planned gain and a poorly timed one can be substantial. The basic rule most people know: hold an asset for more than a year and you qualify for long-term capital gains rates. For higher earners, top out at 20% versus your ordinary income rate, which can be 37% or higher. On a large gain, the difference in tax treatment can be significant. But where I see the real mistakes isn't in the holding period, it's in the timing and sequencing around major events. I had a client, this actually comes up quite often with real estate investors, who was excited to sell a commercial property he held for just under a year. Solid profit, but the short-term treatment on that gain cost him significantly more than he'd anticipated. We've since talked about the importance of calendar awareness before pulling the trigger on any major sale. 12 months matters, but so does which tax year you landed, what your other income looks like that year, and whether there are losses elsewhere in the portfolio that could be used to offset those gains. A few strategies that come up regularly in this area: tax loss harvesting, using underperforming positions to offset gains elsewhere. This is something that should be reviewed consistently, not just at year end. Installment sales, spreading a large gain across multiple years rather than recognize it all at once. There's qualified opportunity zone investments for larger gains, depending on the circumstances and applicable tax rules. Those strategies may provide tax deferral benefits, other potential tax advantages, in exchange for a longer time horizon. And then there's charitable vehicles like donor advised funds or charitable remainder trusts, particularly useful when someone has highly appreciated assets and a desire to give. The common thread in all these: they require planning before the transaction, not after. Once you sell, the options narrow considerably. So if you do nothing, a realized gain is locked in. The planning window closes at the moment of sale. If you're approaching a major liquidity event and you don't have a tax strategy in place, that's the conversation to have first. Mistake number 4: underestimating what you owe and getting caught flat-footed. This one is more common than people want to admit. Higher earners, especially business owners and executives with variable compensation, can have a significant swing in taxable income from year to year. If your estimated tax payments aren't keeping pace, you're not just facing a big bill in April, you're also facing underpayment penalties that may often be avoided through proactive monitoring and planning. But beyond mechanics, the bigger issue is that people who aren't tracking their tax picture throughout the year are missing their best planning windows. Certain planning opportunities may be more effective when addressed before year end rather than after the tax year has ended. Here's the pattern that I see. A client had an outstanding year, business transaction, a significant bonus, strong portfolio returns, all landing in the same calendar year. None of it was reflected in her withholding, and we hadn't yet updated her estimated payments to account for the new income. By the time she came in to review things, we were in January. The tax event was set. What would have been a planning conversation 6 months earlier became a damage assessment conversation. We've built a very different cadence with her going forward. What I recommend for my clients is a mid-year check-in, ideally in June or July, where we project full year income, revisit estimated payments, and identify anything worth doing before December 31st. That window between summer and year end is where a lot of best planning actually happens. If you do nothing, every month without a current projection is a month where planning options are quietly expiring. The tax code rewards people who act before the deadline, not people who react to it. And mistake number 5, getting blindsided by the alternative minimum tax. AMT doesn't come in up in every situation, but when it does, it tends to be a significant surprise. And in my experience, the most vulnerable people to it are executives with stock options and business owners going through a major transaction. Here's the short version. AMT is a parallel tax system. So you calculate your tax liability under the regular rules and the AMT rules, and you pay whichever is higher. The problem is that certain things that reduce your regular tax, like large deductions, instead of stock option exercises, specific depreciation strategies that don't reduce your AMT liability the same way. So you can end up owing substantially more than you expected. Here's a situation that sticks with me. An executive I worked with exercised a large block of incentive stock options. He modeled the tax impact based on the spread, felt good about the numbers, and moved forward. What wasn't fully modeled, however, was the AMT exposure on that exercise. The resulting bill was materially larger than projected. And because a significant portion of the position was still in unvested shares he couldn't sell, he had a liquidity problem on top of a tax problem. This is a challenging situation that may often be mitigated through earlier planning and analysis. Anytime you're planning a major transaction, an option exercise, a business sale, a large charitable deduction, run an AMT projection first. It's not complicated to do, but it has to happen before the event, not after. Again, if you do nothing, there's no AMT warning label. By the time it shows up on your return, the decision that triggered it was made months ago. The most effective approach is often proactive planning before the triggering event occurs. So what happens when these mistakes compound? I want to share a situation that illustrates what happens when several of these gaps exist at the same time, because in my experience, they rarely show up in isolation. A couple came to me a few years into retirement, late 60s, they had significant wealth. They'd done extremely well in substantial retirement account balances, a taxable portfolio, and some real estate. By any measure, they had more than enough. What they hadn't done was map out a full retirement income picture. When we ran the numbers, their required minimum distributions starting at 73 were going to generate more income than they had planned to spend. That pushed them into higher bracket. It affected their Medicare premiums. It caused a larger portion of their Social Security income to become taxable. And it limited their flexibility in ways they hadn't expected. Now, there were still things we could do. Roth conversions in the lower income years ahead of RMDs, qualified charitable distributions. When properly executed and IRS requirements are met, may satisfy a portion of required minimum distributions without inclusion in taxable income. A more deliberate drawdown sequence across account types, but the runway was shorter than it could have been. I tell this story not because they made bad decisions. They didn't. They made very good decisions for 40 years. But their planning had stopped at accumulation. And accumulation planning and distribution planning are two genuinely different things. The strategies that build wealth and the strategies that protect it aren't always the same. This is exactly why I believe in comprehensive planning. This is exactly why I believe comprehensive planning has to be ongoing. It's not a one-time event. Your life changes, the tax code changes. What made sense 5 years ago may not be what serves you best today. So what does it look like when this is done well? In my practice, I think about it as building a tax strategy that's tailored to the person. Because as I said, no two people's situations are the same, and no two people should be doing the exact same things. But there are some consistent principles I apply across all my clients going through significant financial transitions. The first thing is to build across all three tax buckets, which may provide greater flexibility when managing taxable income in retirement. Plan every major transaction before it happens, gains, option exercises, business sale, with full visibility into the tax implications. Maintain a living projection year-round, not just a filing time, so you can act while options are still available. You want to model AMT, bracket impacts, and RMD trajectories as part of every financial decision. And lastly, work with a coordinated team. Your CFP like myself, your CPA, your estate attorney, who are communicating with each other. The goal isn't to minimize this year's tax bill. It's to minimize your lifetime tax burden while still living the life you want to live. Those are different objectives, and they require different thinking. I genuinely believe that people can live the lifestyle they want and still build and protect their wealth, but it requires making consistently good, informed decisions. That's what comprehensive planning is designed to do. If something in this video felt familiar, if you recognize your own situation in one of those stories, that's worth paying attention to. Most of the people I end up working with already knew something was off. They just hadn't yet found someone who would take the time to sit down, understand their full picture, and build something specific to them. If you'd like to have that conversation, I've put a link in the description where you can schedule time with me directly. No sales pitch, just a real conversation about where you are and whether I can be of any help. And if you found this useful, subscribe. I put out content like this regularly, practical, straightforward guidance on the decisions that matter most for people navigating significant wealth. I'm Matt Tuft with 40 North Wealth, and thanks for watching.